How's it going, everybody? Hope you're all having a blessed day. And in today's video, I want to talk about how you can use option trading to get weekly passive income. Now, this is not a clickbaity bullshit video. All you need is 100 shares of a stock that trades options. If you watch my previous option trading video, you have seen that I was talking about buying call and put options. But where do these options actually come from? Like anything in life, in order for there to be a buyer of a product, there also has to be a seller of a product. And this is the same thing for the option market. So if you've connected the dots, you'll know that there are option sellers who are selling these contracts to option buyers. So these sellers are actually betting the exact opposite will happen as the buyers. So if they were to sell a call option, they think the stock is going to go down. And if they were to sell a put option, they think the stock is going up. But being bearish or being bullish is just a general idea they would use for this strategy. As you know, for call options, if the strike price is above the stock price on the expiration date, that means the contract will expire worthless. And we'll see how we can use that in order to profit using this strategy. But the reason why buyers of options are betting the exact opposite of sellers of options is because option trading is a zero-sum game. This means that one person's gain is another person's loss. But anyways, let's see how you can use this strategy to make weekly income. So as I said earlier, the minimum requirement to sell a call option is to own 100 shares of the stock. So in this particular case, we're going to be using the Apple stock as our example. So all you got to do is go to trade options again, and then you got to go to sell instead of buy call. Another aspect I quickly wanted to talk about with regard to buying and selling options is the bid and the ask. This is also called the bid-ask spread. So the bid is the maximum price that a buyer of the contract is willing to offer, and the ask is the minimum price that a seller of the contract would sell this contract for. And as you can see, the price of the option is right in between the max bid and the minimum ask, which is 1.95. Let's say you bought 100 shares of Apple at $150. That means you've already made $24 per share. So multiplied by 100, you've made $2,400. Now your shares are just sitting there and you're not really sure of where the market is going to go, and you'd be okay with selling your shares at this price. So what you can do to make this weekly income is basically choose an expiration date. So this expiry date is February 4th, as you can see, which is this coming Friday. So as you can see, different strike prices have different prices for the contract. So let's say you take this $180 strike price for $33. If you were to sell this option at $33, that means you would net that $33. That means you would get $33 in cash when you sell this contract. What would happen is if by Friday, February 4th, Apple was below $180, that means this contract will expire worthless, right? So that means you'd have netted that whole $33 for just selling that contract, and you wouldn't even have to do anything about it. But before you think this is free money, let me just explain what the possible downsides could be. So if Apple were to expire at, let's say, $185, that means you would be forced to sell the 100 shares you own at $180 because that's the strike price you sold it at. So you'd be missing out on that 5 into 100, $500 if you were to sell that contract. But keep in mind, you would also have made the $33. So to calculate your break-even point is, so you would add 180 plus 33 cents, which would give you 180.33 as your break-even point. Anything below that, you would be in profit, and anything above that, you would be in loss because you would be forced to sell your shares. But if you're really selling your shares at $180 when Apple is at $185 and you've bought it at $150, that still means you've made over $3,000 in profit. And you were forced to sell it at $180 and you also collected the $33 premium from selling the contract. You would basically be up $3,033 from this trade, which is still pretty good. So you might be losing money, but really you're selling for a good profit. And it's always good to book profit unless you're extremely long on a stock. However, if the market were to tank, or if Apple were to tank, you wouldn't be able to sell your shares if you wanted to unless you buy back that sold contract. Let's say you wake up tomorrow and Apple is at $155 for whatever reason, because the market tanked, let's say, and you want to sell your shares and get out immediately. What you would have to do in that particular situation is basically go to buy call option and buy the exact same call option that you've sold. And at that point, if Apple is at $155, you know the price of the contract would have gone down probably to zero. So you would probably have to pay $1 in order to close that option contract. But the thing with that is you would have also lost your $20 when Apple went from $175 all the way to $155. You would have lost that $2,000 gap. But if you're really long on Apple, what you probably would do is sell another contract and maybe use some cash you have to buy Apple at a cheaper share price. So in that particular case, if Apple were to go to $155 and you had sold this $180 call for $33, and let's say when Apple opened at $155, this $180 call was 0.01, so $1. What you would make in that situation is basically the 500, the difference between 155 and 150 for 100 shares, plus $32, so $532 in this case. And you can use these formulas I've mentioned to apply the formula to any sort of price ranges you want. So now let's talk about selling put options. Selling put options technically means you're bullish on the stock, because when you buy a put option, you're betting that the stock is going to go down and below that strike price. But the thing with put options is that if the stock price is below the strike price on the expiration date, then you would have to buy 100 shares, not sell. You'd have to buy 100 shares at that particular given strike price. So let's look at another example on Robinhood. So let's see for selling put options. If you were to sell this $167.5 put option for $45 and Apple expired at $170, that means you would just net that $45 as premium. And calculating your break-even price is pretty similar to that of buying your put options. All you have to do is 167.5 minus 0.45, which is 167.05. And if your stock price is anything below that, then you lose money. And if your stock price is anything above that, then you gain money as you're selling the put option. But the thing with put options is, let's say Apple goes to like $0 or $10. I know that's never going to happen, but just for this example, let's say freaking Tim Cook, it just comes out, there's a report that Tim Cook funded the Taliban, okay? Then obviously Apple stock is going to tank. And if Apple were to go to $0, that means you would be forced to buy 100 shares at $167.5. So you would have to pay $16,750, and then you would basically have $0 worth of shares. So that's the risk with put options. It's always possible that a stock could go to $0, but not probable. And again, in order to close out your sold put option position, all you have to do is buy back the same put option. Although the potential loss is unlimited with selling call options, because the stock price could, in theory, go to infinity, selling a put option would also be really risky, because the probability that the stock price, that a negative article could tank the stock price is always possible. Me personally, I'd recommend using the selling the call option strategy in order to get weekly income. And I'd recommend doing this when on a stock that's not too volatile and when the market isn't being as bipolar as it is now. I recommend you to definitely study the strategy a bit more, as it's a really good way to make passive income, and I definitely think it's really underrated and a lot of people don't take advantage of it. But that's it for today's video. Let me know if you learned anything new and if you liked the video. Also, please like, comment, and subscribe as usual, and I'll see you guys in the next video.